Welcome to Pinnacle Tax Advisory Business Owner Workshops, a series of proven strategies that will save you tens of thousands of dollars every year in taxes. Half of American taxpayers use third-party professionals to complete their tax returns, yet, according to the U.S. Treasury Department, 85% of taxpayers their tax returns, yet, according to the U.S. Treasury Department, 85% of taxpayers overpay. So let's ask, are you satisfied with the amount of taxes you overpay every year? Are you confident you're taking advantage of every available tax loophole or deduction? Is your tax advisor giving you proactive advice on how to save on taxes? Chances are you do pay too much in tax. The good news is you don't have to. You just need a better plan. In this series, we're going to talk about how to capture some of the biggest missed opportunities real estate investors make. Let me introduce our company. We are Pinnacle Tax Advisory. We have been helping clients put together proven tax strategies and preparing their taxes for almost a decade. We have clients throughout the United States, and our headquarters are in downtown Brighton, Michigan. Please visit us at our website or check out our blog, chucks.com. Real estate has always proven to be a great asset both in generating passive income and for harvesting capital losses. Unfortunately, many real estate developers, investors, and landlords leave too many missed opportunities to lower their overall tax bill and fail to capitalize on expanding. We will briefly discover some of the proven strategies that will help you save your money and build your net worth. When it comes to filing taxes on rental properties, you'll start with total rental income. Then you'll subtract your obvious operating expenses like advertising, insurance, interest, maintenance and repairs, professional fees, and the like. But then you get to take depreciation deductions. Depreciation is the process of writing off a capital asset, such as a rental property, over a period of time intended to approximate its useful life. For residential properties, this is 27 and a half years. For non-residential properties, it's 39 years. Depreciation is especially valuable because it's not an actual out-of-pocket expense. But lots of investors miss valuable depreciation deductions because they do not know how to make the most of them. Raw land is non-depreciable. But what about land improvements? Driveways and sidewalks crack, landscaping needs replacing, and pipes from the house to the street deteriorate over time. You can depreciate land improvements over 15 years. If you miss those assets, you lose money. You can also break out personal property included in your property and depreciate it separately. This process is called cost segregation, and it lets you depreciate that personal property over as little as 5 years, which gives you far more deduction in the early years you own your property. Personal property includes all sorts of assets you can break out to boost depreciation deductions. The best part is, if you missed out on these deductions in the past, you can still take them. The process is called cost segregation study, and it lets you go as far back as 1987. Calculate what you could have depreciated versus what you actually depreciated. Then take the difference as a deduction this year. You won't even have to amend your old returns. Just file Form 3115 with your supporting evidence with the IRS. Please see us if you have any real estate you haven't done this. One of the most important decisions you'll make as you own your properties involves distinguishing between repairs and improvements. Repairs are deductible immediately as you make them. Improvements are depreciable over time. It usually makes sense to characterize fix-ups as repairs so you can deduct them faster. The definition seems straightforward enough. Repairs keep your property in good operating condition. They don't add value and they don't prolong the property's use. IRS examples include painting, plastering, repairing broken windows, fixing gutters, floors, and leaks. Improvements adapt your property to new uses, add value, or prolong its use. IRS examples include room additions, upgraded appliances, new landscaping, and replacing components like furnaces, roofs, and windows. But even the Internal Revenue Manual that tells admits that distinguishing repairs from improvements is a gray area. You'd think that replacing a roof is a pretty clear-cut case of improvement, right? Common sense tells you it adds value and prolongs the property's life. But a recent tax court case ruled that an investor could deduct a roof as a repair because it just helped keep the property in good operating condition over the course of its existing expected life. Most investors buy property for long-term investment. Your total return includes current income from rents and long-term capital appreciation. But some investors don't want to manage tenants or hold long-term. They'd rather buy, maybe rehab, renovate, and flip for a quick gain. How does that affect your tax bill? If you buy a property to hold and manage for long-term gain, it's considered an investment. There's self-employment tax on rental income or gains. You can take depreciation deductions. When you sell, you can take advantage of lower rates for long-term capital gains. You can even use tax-free exchanges to defer tax on your side. But if you buy a property with the intent to resell it in the ordinary course of your trade, it's not considered an investment. It's considered a dealer property. It's essentially treated like inventory, just as if you were selling groceries or car parts. You'll owe self-employment tax on your earnings. You can't take depreciation deductions. Your profit when you sell is treated as ordinary income. And you can't use tax-free exchanges to defer tax on your sales. For more dealer properties, the biggest problem is self-employment tax. If you wanted to reduce that tax, you might consider operating that part of your business through an S corporation. If you deal in properties as a sole proprietor or a single member LLC taxed as a sole proprietorship, you'll report your net income on Schedule C. You'll pay tax at whatever your personal rate is, but you'll also pay self-employment tax of 15.3% on your first $117,000, then an additional 2.9% on anything above that. You'll also owe a 0.9% surtax on earned income over $200,000 if you're single and $250,000 married jointly, or $125,000 if you're married filing separately. Let's say your profit at the end of the year is $80,000. You'll pay regular tax at your regular rate, whatever that is. You'll also pay $11,000 in self-employment tax. The self-employment tax replaces Social Security and Medicare tax that your employer would have paid and withheld from you if you weren't self-employed. How many of you are self-employed? How many of you plan to retire on Social Security? An S corporation is a special corporation that's taxed like a partnership. The corporation pays you a reasonable wage for the work you do. If there's any profit left over, it passes through to you, and you pay the tax on that income on your own return. So the S Corp splits the owner's income into two parts, wages and pass-through distributions. Here's why the S Corporation is so attractive. You'll pay the same 15.3% taxes on your wages as you would on your self-employment income. But there's no Social Security or self-employment tax due on the dividend pass-through. The corporation earns that same $80,000 as your proprietorship. If you pay yourself a wage of $40,000, you'll pay about $6,100 in Social Security. But you'll avoid employment tax on the income distribution, and that saves you $5,184 in employment tax you would have paid without the S corporation. As a business owner, you hire accountants and CPAs to do your bookkeeping, payroll, human resources, and to file your taxes on time. There's an underlying assumption that as they perform their duties, they would be looking for ways to save you money in taxes. Unfortunately, this is not normally the case. Accountants and CPAs focus their time on GAAP methods and compliance, while a certified tax coach is disciplined in researching and validating specific strategies that lower tax obligations within the guidelines of the IRS code. These elite tax professional strategies for you, the business owner. So what do you get when you hire a tax strategist? A tax planning blueprint tells you what to do, when to do it, and how to do it. You complete a questionnaire about your current revenue and expenses, projections, and goals. They'll review your last 3 years' tax returns to find savings that may have been overlooked. Then you'll receive a written tax plan that addresses your family, home, job, your business, and your investments. We would like to invite you to experience the value of our services with not just one but two free, no obligation tax strategy sessions. The first 30 minutes we will review your business entity choices, profit and loss statements, financial statements, balance sheets, and trial balances. We will look at the last 3 years' tax returns for missed opportunities. The second meeting is a broad overview of the tax plan where we identify potential areas for tax savings for past, present, and future tax years. If we agree that we can save you a considerable amount of money in taxes, then we will then forge a consulting relationship. One of the best parts of working with a certified tax strategist is we put our money where our mouth is by giving a 100% refund guarantee to our. If we have not given you proven, legal, and ethically sound strategies to considerably minimize your taxes, we will refund 100% of your tax blueprint consult fee. Meetings can be held over the internet through Join Me. They can be held over a conference call or face-to-face. Please know, Pinnacle Tax Advisory, its principals and employees, do reserve the right to charge a per diem to reimburse travel expenses incurred for meetings held outside a 50-mile radius from its headquarters in Brighton, Michigan. We want to thank you for spending time with us discussing briefly